Welcome to Wealth Matters Podcast. This is episode number 100. I never thought that I would reach episode number 100 of Wealth Matters Podcast. When I started, that was not the goal. The goal was just to start something like a revolution, especially for me and my friends, so that I can learn as well as they can learn from this podcast. The goal was to help everyone build some kind of second stream, third or fourth stream of income, uh, and set them up on a path to build legacy wealth. So I'm pretty excited today because it's been almost a couple of years. I recorded my very first episode in 2018 on the day of my daughter's birthday. So I remember that day, and she's about to turn 11 in 2 weeks. So, I definitely remember the day. And I kept thinking about what should I do for episode number 100. I have decided not to interview anyone for this episode, but I want to go through my story itself. Where am I right now in the journey as well? Because I have not spoken about it for a couple of years. So, as I mentioned in my earlier podcast episode, as well as my first episode of Wealth Matters podcast, that I started investing. I became accidental landlord in 2011. So I learned about real estate and then jumped into real estate or bought my second property in 2015. And since then, I have sold that property. So in 2015, I bought my very first single family property in Cleveland, Ohio. And you can listen about that property in my earlier episodes as well, where I lost every penny I had invested in that property. But while I owned that property, I bought another one from a turnkey provider in Milwaukee, Wisconsin. I bought a second one in Milwaukee, Wisconsin. All of those were small single family, priced between 50 to 90 grand. That was the goal. And then I also bought a couple of properties in Quad Cities area, uh, quads in Iowa and Illinois. It's East Moline, Davenport. It's called Quad Cities MSA, and that area seemed pretty stable. So that's what I did, and I ended up with total five properties by end of 2017 ish. Yes. So by end of that, and my fifth property was actually a duplex because I started learning more about scaling up, multifamily, etc. So I ended up buying that duplex. And I mentioned Devonport as about right now because I still own that one property out of all those five. I still have that duplex in Devonport, which is doing well. And I think, and that was my last property in that turnkey saga. So as you can tell, when I moved from my first property to second property, I had learned some lessons. I kept applying those lessons in my each of my acquisitions. And so at the end, my last acquisition with the turnkey provider was this duplex in Davenport, Iowa, which I have kept so far as well. And that's why I highlighted that. By the way, we are evaluating building a brand new construction senior housing facility in Devonport. So definitely it's a growing market. It's a very strong MSA. And, the partner I'm working with, they already own and have built couple of properties in Iowa market, mainly Des Moines market as well. So we are looking forward to that. Most probably we'll be starting the construction in March of next year. So nothing has finalized yet, but just wanted to throw it out there. So after doing that last acquisition in 2017, I kept thinking, what should I do? And I also want to highlight here that if you buy a property which is a single family condo townhouse, which is one door to up to four doors, so duplex, triplex, or fourplex, they all can qualify for traditional financing. What I mean by traditional financing is the financing we get when we are buying our own primary residence, right, through Fannie and Freddie. So you can get traditional financing, and that you can get for up to 10 properties. And again, why I'm specifying that if you want to scale up, start learning, then you can start buying duplexes or maybe buy fourplexes, right? Four doors in one loan under one transaction, one market, and also you have to just go through the research one time, right? So that way you can start scaling up. But with traditional financing, you can go up to 10 loans. So let's say if you buy only single families, you'll end up with 10 single families. And then you'll have to start looking for commercial financing, start working with credit unions, or maybe look at portfolio lending, et cetera, et cetera. So there are other ways, but of course, they are not as easy to get as a traditional financing, because most of the time traditional financing will look at your income, and if you have had a couple of these properties for a while, they'll also I mean to say, if they are seasoned also, right, then they will also consider that income as well. So that way you can go up to 10 properties, right? So my goal was, when I started thinking about it after having those 5 properties, and of course, by that time I had lost that first property already. So I had 4 properties. I said, okay, I want to go grow as well as scale up. So I started looking at, anything above 4 or 5 units, right? I didn't know that I kind of knew it needed a commercial financing, but I didn't know how difficult it would be to get the commercial financing. So I ended up getting under contract in 2017 a 9 unit with my business partner from my IT business in Ridgecrest, California. And as I have mentioned before, I do not invest in California. So that was my only investment in California so far. Of course, I'll also talk about in the podcast about what we are up to as well, and what I'm trying to do in California, because I live here in San Francisco Bay Area. I needed to always, think about that as well, if I can, build my business in surrounding areas as well. So that 9 unit we acquired for around 400 grand. It had 9 units. 8 units were rented or about for 450 bucks at that time each. When we kept rehabbing slowly. We didn't do a lot of work, but pretty simple rehab. And then we would, bump up the rent to 475. And at the end, we had all 7 units rented. So we were getting about 4,275 in rent. And that's crazy in California. That's unheard of. So that was the whole reason I invested in Ridgecrest Market. And also it had to do with my business partner, because he was brought up in Ridgecrest. He knew the market really well. He already had owned tons of properties in the area, and he still continues to own. He actually owns now commercial building, etc. But again, why I brought up Ridgecrest, that we just sold that property. We tried to sell it last year, and while it was on the market, there was an earthquake, large earthquake, which hit Ridgecrest area, and we couldn't sell it. We had listed it for 525. And this year again, we tried to sell it right when COVID hit, and we had to keep dropping the price. But in the end, we sold it for 480 um, grand. So we did make pretty not great great profit, but it was still, we all doubled our money in 3 years. So it worked out well. But while after I owned that 9 unit property, I ended up buying second one in Birmingham, Alabama, and that is my another 9 unit property. I still own it, and it's doing good. It took me, I didn't realize that when I acquired, again, it was around 395K for 9 units. The rents were pretty high. Were higher because they were all 2 bedroom, 1 bath. So the rent, it would command, I knew, high rents. And they were all rented for about 550 a month. After I acquired, once the lease was off and tenant moved out, we'll update it. All the, really, when we update it, it's brand new carpet or really nice, luxury vinyl floor, every paint, etc. Nice appliances. So it would cost me about 5 grand a unit, and we had bump up the rate rent to um, from 550 to some of those units about 650 as well. So depending on the amount of work which was done, as of now, the rents range between 550 to 650. So the property finally, after a couple of years, because we were putting money into it, right? So that was the reason it wasn't giving me any solid income. But starting this year, it's been producing pretty well. So I'm just gonna keep that property. And other than this, so as of now, that 9 units and the prop duplex in Davenport, I own a couple more properties in Atlanta, Georgia market. So because I now I'm so focused on Southeast market, as you can tell, Alabama, Georgia. We also acquired my Wealth Matters first mobile home park in Columbus, Mississippi. Again, it's so that way I want to stay in the same area, Southeast, because I like that area, as well as for it's easier for me to travel. So I fly into Atlanta airport. I can visit my properties about an hour from Atlanta airport. Then I can drive another hour and a half to Birmingham, Alabama, to look at my 9 unit. And from Birmingham, Alabama, again, I can drive about an hour to an hour and a half and visit the Columbus, Mississippi mobile home park. So that way they are also in the same area. I shouldn't say same area, but it's easier for me to travel there. So that's what uh, I have done so far. And pretty much we are working on that mobile home park, trying to fix it up and rent out all the park owned units. So as I mentioned earlier, I also own a couple of duplexes in Atlanta. One duplex is owned by me, the other duplex is owned with a partner. Same way, the mobile home park is not just owned by me. It's three partners and myself in that particular deal. So again, after I learn something, I try to apply in other types of asset types of real estate, right? So at the same time, while I was doing that, I had also invested in multifamily syndications in 2017. The very first syndication I have invested in or had invested in with a celebrity multifamily syndicator, like huge name. You can't miss that name, and they just closed on that property. They sold the property, and it's 100% loss for all the investors. So I also syndicate, but I always make sure that the deal is solid and sound, and I also make sure that I have enough skin in the game, right? So don't go after every celebrity syndicators who are advertising on social media all over the place, and definitely not just celebrity, but check their track record. Ask them about their investments which went south, right? It's really good to know. Not don't just look at the investments that had made money, because in last 5 years any monkey could have made money in real estate or even stock market, as you can tell, right? So you get to see if someone has been in the market for a while and what that track record is. Because I've heard that still this celebrity syndicator is losing money on three of his properties right now. Then I invested in a self-storage syndication, and that has worked out so far well. So it's ongoing. I still get quarterly payment, so I'm okay with that. I had also invested with another big name, the number one. I think they are in top three podcast on iTunes, and that hasn't been good either. So I'm hoping that it would turn around. But this was again in 2017 when I was just starting with syndication. Again, I put money in so that I can learn, and that's me. That's I just take action. I'm very adventurous in the financial world as well as business world, and even on the fitness side, because I try to stay on top of things, right? And that's why my shirt says never broken, right? Because you can never be broken, right? If you even if you take chances, as long as you are prepared. uh, So in the meantime, also because I'm always I kind of have, I go after shiny object syndrome, and that's what people call it. I call it as experiment or diversification because I always want to start building income stream. So I had also done a lot of the things in the meantime. In 2017, I've started cryptocurrency mining company with three of my top friends. We, of course, closed it down last year when the crypto prices dropped and it was not sustainable to mine the coins, right? Because the cost of the electricity and in office space, etc., was more than the coins we were mining, so it wasn't worth it. But that got me started in crypto space, and I just kept investing. I kept learning about crypto. I even became, the more I learned, I look at it as again stock market, but stock market is so controlled that I wanted to have by Wall Street, by hedge funds, etc. I wanted to have my money outside that Wall Street game, right? So that's why I still have those cryptos. I'm just keeping it for long term. Crypto or those kind of investments, even some IPOs, etc., will give you velocity. Well, what velocity means is that you can put a $1,000 and in 10 years it could turn into zero, or it could turn into 100,000 or a million, or I don't know, right? So that's the velocity piece, right? So you want to put money which you know that you'll be okay to lose, but it could turn out something big, and that's why I signed up for Palm Beach Research Group's newsletter. If anyone of you wants to know more about that newsletter, please ping me, email me, message me on LinkedIn, Facebook, wherever you find me. Um, and I can tell you more about it, about the service, how it works, etc. And I can even, share some of my analysis how it has worked out so far. So that was the jump into cryptocurrency company, which we closed um, down last year, but it definitely got me started with crypto. Because before then I had owned some bitcoins and then sold them. So I did knew little about it, but I did not know that there are a lot of other altcoins, and maybe you may not know either. But there are more than 1,000 something altcoins, and if you consider the ICO or the coin offerings, um, uh, that there are way more than that, right? So and since then, I'm going to continue to own those cryptocurrencies. We'll see what happens. Some of them, when the market consolidates, they may go to zero, or they may turn out something big. And this entire episode, I have not scripted it. I'm just talking as I go because I wanted to keep it, you know, more like conversational, even though I'm just talking. So I didn't want to, script it or look at, a notebook or something. I'm just throwing out what I have learned so far. So I'll really appreciate if you can share this podcast episode or my podcast with your friends and family members. I really need, as of now, I have around 31 ratings on iTunes. I want to reach 100 ratings as soon as possible. So if you are on Apple Podcasts, please review and provide a rating. If you are watching this on YouTube, please like, share, and subscribe. I'll really appreciate it. I really want to send my message out to a lot of the people who are working W-2 jobs and they don't know any other way. I want them to start thinking about building multiple streams of income. And this is why I try all of these things for you guys, right? Of course, I'm selfish and I try to build the income stream, but even before I try to learn about it, I go ahead and put my money where my mouth is. This is why I had invested in those syndications, because those guys were selling, saying, "Oh yes, if you invest with me, you are going to double, triple your money, blah blah blah." So I wanted to see it myself, because lots of time, you can learn as much as you want from outside, but unless you do it, you are not going to know how things work, right? It's like learning and going to medical school, becoming a heart specialist. But unless you are going to perform a surgery, you wouldn't know how, it works, right? You can learn as much as by opening the book and going through it. So again, I would really appreciate if you can, share, subscribe the podcast on YouTube, iTunes, etc. Leave a rating, review. This will help me not only get my podcast on top of the queue, but also help me attract really good guests for all of us, right? Because we want to learn from the best in the industry. So that's the goal. So after that keep crypto experiment, we kept it for about 2 to 3 years, and that taught me a lot about crypto. There was always something else I wanted to learn, right? Even in the real estate space, uh, I have been learning about senior housing since 2018, looked at about seven or eight properties and analyzed tons of them in 2018 and 17 as well. Just things couldn't work out. Last year, finally, I met someone who was trying to buy senior housing facility here in California. They went under contract in October. We were about to close in March when COVID hit and the lender backed out. So, long story short, after 6 months, finally we could not close. You would think that this story will end at on a positive note, but that's not what happened, right? So we ended up not closing the because there were lots of issues. Finally, there were COVID cases, but I'm very gung ho about three asset classes, right? Because I think single family and multifamily are going to stay. We all know that. So if you are doing that, I'm not asking any of you to stop or any of. I always even recommend people to do both active and passive investing. Active means you buy a property, single family, duplex, triplex, or even bigger, and and then you get it managed or manage it, but learn how it works. And all a passive means invest in syndications in larger deals where you have lot more diversification, right? So you get basically diversification two ways. One, the market diversification where you personally invest actively, and wherever the syndicator is investing. So you could be in two different markets, let's say Atlanta and Dallas, Texas, right? So that way you are already in two different markets, as well as in two different asset types. Maybe you are investing in single family and you put your money in a mobile home park, a self-storage, or multifamily. So I'm not going to talk about single family and multifamily here because everyone talks about those. Personally, I'm trying to look beyond those right now, and I want to focus on, as I say stated, we just acquired the mobile home park in August of 2020, and I'm looking forward to acquiring more. Most probably not this year. I even would have gone under contract on one park and then decided that I would like to wait and watch on the election what happens, and then maybe pick up next year. But mobile home park, I love that asset. The second asset I like is the senior housing industry, and I had interviewed Michael Osteroff on one of the podcasts, Louis Hornbuckle on earlier episodes as well, where we discussed why senior housing. And you can look up Gene Guarino and learn from him as well about senior housing, that we are going to, it's a silver tsunami. It's going to hit us no matter what, maybe 2024, 2030. But at some point, senior would be the largest population base in America. So and they are going to need a place to stay. So I'm definitely pretty excited about that asset, and that's why we are looking to build a brand new when you cannot find value in buying an old asset. It's better to just build a brand new asset, right? And the third one is self storage. I think that industry is resilient. I am looking at some, but again, I don't want to stretch myself out because I want to keep focusing on mobile home park and senior housing. Mobile home park I acquired myself mostly, and senior housing would be, of course, I'll be relying on a strong operator who I know and trust with my business knowledge. as well. And self-storage, same thing. I'll look into someone who is really strong, who already knows this industry. So those three would are here to stay. And the other one I've been talking to friends as it's office building market. And for that, I had interviewed Brian Adams on my podcast. So actually, we are looking at a deal already. So if anyone is interested, please reach out to me. I had shared the deal already with uh, people who had signed up to be part of my investor club and newsletter. So if you are not on the newsletter and not part of club, I will recommend to sign up so that you can get first dibs on all these deals. So that's where we are on that office building space. But mostly, yeah, my focus would be for next year, same thing, mobile home parks, senior housing, some self-storage I'm hoping to get into. So that's where I would be. I also want to talk about how I'm diversifying. So as you can tell, I have 9 units, I have duplexes invested in. I also last year invested in another multifamily syndication. It's in Savannah, Georgia, about 3 hours drive from Atlanta. It's a very strong market. We are going through the rehab and trying to stabilize the property. So that's another part of syndication. And then another thing I'm doing is that my business partner, who is my for my other business construction side, where I'm getting into it, he already owns a construction company. He's a builder. He's a realtor. He builds single family houses here in Central Valley of California. So not Northern California or Southern California, where every house is over $1 million. He's focused in the Bakersfield market. So together we have acquired about 5 lots, and that's what he has been doing since 2011, 2012, that he builds the houses and sells them to retail buyers. So actually we are just going through the plans right now, and we are hoping to start the construction by end of November. So once we get the plans, we are going back and through forth with the architectural company. Once we get the plans, we'll submit it to the city. Tehachapi is the city where we are building these houses. The demand is enormous there, and these are more in the affordable housing range. The houses over there go between around 300 to 400K. So our goal is to build those houses and sell them out. So if anyone is interested in parking their money as a private lender, we are looking for private lenders as well. So do reach out to me. This would be in this deal will be paying out between 11 to 12% of annualized interest as a private lender. And this kind of private lending is the best for, I talk about solo 401k, not solo 401k, but especially for self-directed IRA. And the reason is, if you use self-directed IRA to acquire a real estate which has leverage, or so when I say leverage is some kind of loan on it, then you could be subjected to UBIT or UDFI, unrelated business income tax, right? So if you acquire single family with 50% down payment and 50% loan using your self-directed IRA, you will end up paying some additional tax. So I don't recommend, and this is, I learned this the hard way as well. So I don't recommend putting, unless you exactly know that this asset will triple and would cover way more than the taxes I will have to pay. But personally, I would say instead you should be using that money to be a private lender or invest in different type of assets, right? So this would be the best, because this private money lending would be on interest only. There won't be any leverage. So this could be an interesting opportunity as well for everyone. Again, I'm not just trying to sell these deals, but I want to explain you guys what I'm up to, right? As you can tell, I moved from single family, have invested in a couple of multifamily syndications, self storage. Um, in the meantime, also I ended up acquiring a coffee farm parcel, half an acre in Panama, and also half an acre orange tree farm parcel in Paraguay. So, and I have not been to Paraguay yet, but I did go to Panama and Belize to take a look at that farm. So that's another way for me to diversify. So, I'm hoping all of these investments at some point will start generating enough income for me to replace. I doubt it can replace on my entire income soon, but hopefully it can replace so that I can sustain my lifestyle without worrying about my full-time IT gig. And again, most of you who knows me, I have not been a W-2 employee since 2011, since I started my business, IT business. And so I still work for my IT business. My goal is to, continue to work in it till, I can sustain or all my investments as can start uh, giving me enough uh, secondary income, and I should say call it as primary income. Not only this, in the meantime, I had invested in lots of pre-IPO companies as well. Some of them bust, some of them worked out. Actually, lots of them bust. But that's how investment is, and I always look at it that way. Um, but the ones which work will cover everything, or all the money you would have lost on the busted companies, right? So let's say I had 50K. I invested small amounts in different uh, companies, and I would say almost 80% busted, right? But the 20%, out of the 20%, I'm still waiting on one company. So 5% I'm still waiting on it, but the other 15% pretty much covered the loss I had, right? So that's how it works. So I'm hoping, and I recently invested in Airbnb and Robinhood as well. Let's see, hopefully they go IPO soon. And again, that I go with, I try to diversify how I mentioned, and with crypto as well, that instead of putting 10 grand in Bitcoin, take that, divide it in chunks of 200 to 400 grand and put in, 10, 20, 40 different cryptocurrencies, right? And wait for them to grow. I'm pretty sure 50% of them, or maybe 70% of them, will disappear, but the rest would give you 1,000% to maybe 10,000% of gain that would cover and maybe make you way more, right? That's the part of velocity, and that also goes the same thing with other businesses. And so if you have any business idea, or if you already have a business, please reach out to me. I would love to hear what you are up to, because I'm always into building, not only investing, but building new businesses. I love that process. Again, I don't have the acumen or stamina to work 80 hours a week. So, I rely on other smart people like you who have the idea and need some push or need some help. I can connect you with the right people as well in the industry if need be. Again, I tried to share whatever I have learned so far. My goal is to keep learning as much as about other asset types in real estate, as well as whatever else we can do. I had not spoken about life insurance, so my wife and I took out the whole life insurance policy as well, so that that policy is growing right now. So that's my another savings, another income, and I can take the loan as and when needed. So what I do, the HELOC I have on my primary residence, as well as this loan from the life insurance, I can acquire property as and when I want. Literally, if there is a deal and if I really need to, if I'm very interested in it, I can just take out the loan, acquire it, and then just pay it back. So and that loan does not show up anywhere on your records, right? So that way I'm already saving that money, putting that money aside, and taking it out as and when I need it. So that life insurance is another strategy I love. Whole life insurance, you can even look in IUL, Index Universal Life, or there is another strategy called Kaizen. If any of you are interested in any of those strategies, do reach out to me and I'll tell you pros and cons of each, because I pretty much own or have all of those insurance policies. So let me correct myself, Kaizen, I'm looking into it. I may get it. Right now, I do have IUL, Index Universal Life Insurance, and Whole Life Insurance. So they all have their own pros and cons. And I would recommend you go to specific agent who focuses and works on those policies. So my whole life insurance is with one agent, and my UL is with another. And the Kaizen, I'm looking at it with third agent, right? So not all agents know all of this policy well, so that they can educate you to make an informed decision, right? Uh, the other strategy I recommend highly, if anyone is using HELOC to pay down your mortgage, and it works again like a velocity. Let's talk about the biggest expenses in your life. I would say two: your taxes, and the second is your mortgage, right? Taxes, we can never get away with it, right? So that's why we invest in real estate, so I can have depreciation to write off lots of my passive income, or not lots of, almost all the time. All my passive income is written off and I have passive losses, right? So that's why we invest in tax advantaged investments. This is why I don't like stocks. It's manipulated. Wall Street, there's a lot of greed involved. It's emotional. Already my 401k is in Wall Street. People don't realize that as well. That yes, you can play here and there, and that's what I do too, just for fun. But I would not put all my nest eggs in one basket in Wall Street, right? I want it to be diversified. So and it does not give me any tax benefits. On the other hand, real estate, I can let it grow, and I still have lots of tax benefits because of depreciation. So that's why I love real estate. But you can use HELOC strategy to pay down your mortgage. Basically, for it to work, you have to analyze your total income and total outgoing in or expenses. So pretty much your credit and debit, and then figure out, you got to have positive number, right? So your income has to be way more than your expenses, plus you got to have some equity in your primary residence. So if you are interested in learning more about that strategy, I had already record, there is a podcast out there on wealth matters. I think it's podcast episode number 2 or 3. You can look into it or reach out to me. I'm already going through that strategy. um, and I'm hoping that once I become mortgage free, and second, when my income is fully replaced by my secondary third stream of income, then I'm pretty much, I can call myself as financially free. That does not mean I'm going to retire. I do not like fire movement where they say financially independent, retire early. Have you seen anyone retiring? I have not seen personally, unless they hit a jackpot like Facebook or something. And even then, Mark Zuckerberg is working. Elon Musk is working. Jeff Bezos is working. Bill Gates worked for his entire life. Warren Buffett is working. So no one retires. But basically, having that financial independence, or once you become financially free, gives you time freedom to do whatever you want in life. And I would take that over anything, right? Because I would love to spend time with my family all the time. I would love to go on fitness expeditions. I would love to do whatever I want, but still keep working, from wherever I want. So this was the entire message. Too much blabbering, and I'm sorry about that, but I hope you get something out of it. To episode number 100, and hope to reach 200 soon. Please subscribe and share. Thank you so much, and namaste.